Welcome to Markets in a Minute. My name is Austin Duke. I am financial advisor and chief investment officer for Diamondback Financial Services. We are a wealth management firm focusing on clients who recognize the need for solid financial advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, March 9th, 2026 edition. Let's get started. Investment values fluctuate on a daily basis for a variety of reasons, and our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. Diamondback Financial is a long-only investment firm, which means we try to keep your money invested in the areas that we offer the best prospects for growth as opposed to trying to time the market. We focus exclusively on traditional investments of stocks, bonds, and cash, and we analyze fluctuations in the stock market and in interest rates to help drive our overall investment process. We'll start by looking at the S&P 500, which is an index of the 500 largest companies in America. Over the last 2 weeks, we saw a decline of 2.45%. That brings the year-to-date progress of a decline of 1.54%. What's interesting though, if I had shown you this chart on any other given 2 week period, right, this does not look out of the ordinary. We see these little fluctuations. We've been in this trading range for really the better part of the last 6 months. But if I had told you that we were in essentially at war with Iran, this is not the chart of the stock market that I would have anticipated. Um, I mean, we did see some significant declines on some of these days, but we also saw rallies on the back of those declines. The longer that the war goes on, obviously, the higher the risk that the market does see a sharper decline. But still, for what we've been dealing with the last week, just a very interesting kind of a shrug from the stock market. As far as what's working, what's not working, this is a year-to-date progress, but our top companies from NVIDIA all the way down to Eli Lilly, they're all showing losses or declines so far uh, for the first couple months of the year. We don't really see a positive contribution until we get to Exxon, which, based on the oil issues that we're dealing with Iran, uh, it doesn't surprise me that ExxonMobil's having a good start to the year. On the downside, sorry, where are we? We are looking at contributions from, yeah, Magnificent Seven companies. Sorry, what I wanted to show the companies that are doing the best. We are seeing essentially companies that are not as affected by the war. So there's still some technology companies out there. We are seeing some defense companies like Lockheed Martin, and others, other energy companies, et cetera. Still some huge gains from some of these companies here so far this year. I think there were other companies like Walmart, Costco that I was seeing that people are still going to be spending money, right? We're still going to make our Costco trips on Saturdays. We're still going to go to Walmart. We're still going to be getting healthcare, et cetera. So those companies that we still spend our money regardless of whether or not we're at a war are still doing pretty good. As if we move on to an analysis of interest rate markets, we'll look at those that are issued by the U.S. Treasury Department. And interest rates, they are factored into every investment calculation. So generally speaking, lower interest rates should lead to higher stock prices, but higher interest rates would ultimately lead to lower stock prices. In this chart, we've got interest rates listed over here on the left-hand side. We've got maturity dates down here on the bottom, from 1 month all the way out to 30 years. So each of these dots represents an interest rate for a given maturity date. The green line is where we finished on the 6th of March on Friday, and the brown line is where we were 2 weeks prior. So you can see that interest rates did go up over the past 2 weeks, pretty much across the board. If we look at a chart at what the 10-year Treasury has done over the past year, we were in a pretty significant decline in interest rates from about 4.3 below 4%, about 3.95, And then we went to bomb Iraq or not Iraq, Iran, and the 10-year treasury has gone up significantly since then. We also want to look at spreads. So we look at high yield bond spreads as a measure of probability that these companies would potentially default on their debt, and it gives us an idea if we're expecting companies to default on their debt, right? We would want a higher interest rate to try and compensate for that higher probability. And if we have low spreads or tight spreads, that generally tells us that we're not very concerned. As we've mentioned in the last couple episodes, we are seeing an uptick in these treasury, or not the treasury, in the spreads, which could be partly because the U.S. Treasuries were coming down, and so the spreads were going up. If the interest rate on a corporate bond stays the same, but the Treasury rate goes down, naturally that spread is going to be higher. And so we want to see if that's the case, or if it's because we're charging a higher rate on these high yield bonds. So for now, it doesn't appear to be anything significant. We're still below. It's 300 is basically 3%. So we've been below this 3% level for 8, 9 months. It really is not an issue. Well, we saw a spike back when the tariffs were first put on by President Trump. Like that's the kind of move that we would be concerned about if it got up there and it was sustained. But below 3% is really nothing to worry about, even though we're seeing an uptrend. Like this could play out similar to how it was just 6 months ago, and it could come back down, assuming that we don't end up in a prolonged conflict with Iran. As far as the Federal Reserve and what interest rates they're setting, right now we've got a target rate at about 3.75%. These are the meetings that are upcoming over the next 2 years, and we've got probability of whether or not they're going to cut interest rates or raise interest rates. Right now, we're not expecting anything at the meeting coming up on March 18th. And we've mentioned before, Jerome Powell's term as the chairman will end in May. And so we believe that we're going to see interest rate cuts in the second half of the year, most likely starting in June, even though right now the market's predicting no much better than a 50% odds of a cut. The market's thinking it's probably going to be either at July or September. We still think we forecasted 3 cuts over the course of the year. We think those are going to happen in the second half of the year. So we'll see how things go there. It was interesting because we've got some economic data to suggest that the U.S. economy could benefit from a reduction in interest rates, right? If we reduce interest rates, we reduce the cost of doing business for the small companies and even larger companies in the economy. They can then use those savings on interest to hire people or expand operations, right? So we're not seeing a lot of job growth, which could also be a combination of negative migration. We've had people self-deport, we've had people get deported, and instead of creating jobs, we're filling those jobs with US citizens. So the job growth has been very flat, very anemic. Um, but the economy is still growing, right? Our gross domestic product, our GDP is still growing. So it's a very interesting time. And then we have this conflict, right? Nobody saw it coming necessarily. I mean, we didn't see it coming. Nobody was in my ear letting me know what was going on. But this is a chart of of oil futures. So here's end of February, right? We ended the week at around $67 a barrel, and then within 1 week we are up over 90, which is a more than 35% gain in 1 week because we've got 20% of the global supply of oil that is on hold in the Middle East. So until we can get the oil supply moving, we're probably in for higher oil prices in the short term and higher gas prices. So I anticipate President Trump will hear a lot from other people in Washington, and hopefully those of us who are gearing up for spring break trips and not wanting to pay a lot of money for gas if we're going on a vacation. But as far as what we've seen, right, like that, there's a lot going on, and it's still very fluid. And by the time this comes out on Monday morning, a lot of this could change. But this is essentially what we've seen over the last week and 2 weeks in the markets. Okay, as far as expectations and implications portion, um, we are 1 week into this conflict in Iran. It doesn't seem like there's many people helping Iran. It feels like everybody's on our side. I am hearing reports that Russia is providing intelligence to Iran, but no air support, right? No actual military support to fight back in this conflict. So um, the U.S. is coming out and saying it could be 3 or 4 weeks, which would basically be the entire month of March. And so far, the market doesn't seem to be too worried about what's going on. Again, the longer it goes on and the less clarity, the more uncertainty we have about an actual end game is what's going to be, in our opinion, driving the market up or down. If we start seeing, I think number one objective is going to be getting the oil flowing again, um, which would bring oil prices down, it would bring inflation expectations down, allow the Fed to either cut rates or hold them steady without any concerns. Should allow the stock market to return to normal. But beyond that, we then expect that they're going to need to find somebody to negotiate with, and um, it doesn't appear that there is anybody right now. And a lot of positioning, a lot of posturing on both sides of of the conflict, and people not wanting to back down. But ultimately, eventually, we anticipate that's going to happen. If you remember, just what was it, a month ago, President Trump was talking about going and taking military action against Greenland, and then all of a sudden we didn't, and we came to some agreement. Like, I mean, I almost forget about these things that just seem to be like so in the moment, and then they just get resolved. So everything was looking fine with the economy and with the markets before we invaded Iran. And if this is short-lived, then we anticipate that the global economy and the global stock markets will return to where they were before. But I mean, this isn't even a 5% decline. So let me pull up this this chart again. If we look at the stock market, we've talked about before how in a 12-month period, we will typically see declines of 5% 3 times in a 12-month period. We'll see 10% declines once every 12 months, and then we'll see 20% declines once every 3 years. Now, this is a 12-month chart of the stock market. We had that 10% drop, a little more than 10% back here when the tariffs were first announced in the beginning of April. And then we haven't seen a 5% decline until back here in October, November. Like we barely got the 5% decline. And then we've just been in this trading range. Like we've been totally flat. And from the all-time high, just under 7,000 that we hit at the end of January, we're down about 3.5%. So it would not be uncommon, right, for this to become a 5% decline. It would not be uncommon for this to become a 10% decline again if we have more of a prolonged conflict with Iran. So right now, our expectations are the US is going to try to get this done before the month is over. And we're not wanting to make any changes. We don't want to sell and go to cash and expect that this is going to be a significant drop in the market. We don't want to try to reposition into areas that maybe like if we had known a week ago, like we could have positioned to benefit from the oil spike. Really don't think there's a whole lot more going on with oil, and especially if we have some kind of a deal announced this week where we get oil flowing again, those prices should come down. So we're just kind of holding steady. We want to see how this plays out, give it at least another week to see what kind of progress is made before we start making any wholesale changes. But we really liked the strategy. It was working well in 25. It was working well in the beginning of 26. So we are hoping that this is something that we can get through relatively quickly and get back to making money and back to growth. Like we think there's so many tailwinds. Like a year from now, Like that's what we're trying to figure out 6 months from now, a year from now. If this is behind us, where do we want to be invested so that we can get the most growth over the next 6 to 12 months? So yes, it's painful to go through. Yes, nobody likes watching the stock market go down or your account values go down. These things need to play out without making any knee-jerk reactions. So we are watching it. We are in the office every single day. We're making sure that the things aren't getting any worse than they already are, and we've got measures in place so that if we feel like this is not going to end anytime soon, we can make some changes. But the bottom line is President Trump uses the stock market as a gauge to whether or not what he's doing is working or not. And so if we get enough of a decline, it could be 5%, it could be 10%, he'll make a deal so that the stock market recovers. So another reason why we don't want to make a lot of changes, knowing that those outcomes are around the corner. All right, as a final word, this was the Consumer Protection Week this last week, and Social Security Administration had what they called Slam the Scam. And I thought it was worth including as a final word because there's a lot of scams out there. Artificial intelligence is making it more difficult as well to determine what's real, what's fake. So some of these signs still ring true even in 2026. So just be aware that there are people out there who want to steal your money. Um, Most people are good, but you still got to be aware of some of these things. So anything that's too good to be true, any kind of high pressure tactics, any kind of contacts that are coming out of the blue, or anybody who wants to access and download information from your account. So they generally will come through email. Sometimes they're coming through text or phone calls. Um, but please be very careful with what you're getting into or what you're responding to. And it's always good to run something by another person, a friend, family member. You can run things by me. We're happy to take a look, and we're never going to be upset if you are wanting to check and make sure that you're not being scammed. So um, that's going to be it for this week. Hopefully, in 2 weeks, we're in a much better position, but we'll keep our fingers crossed and see you soon.